So we talked about price controls in the last video, and now we want to talk about the other government policy which can alter market outcomes, which is taxes. And there's two primary types of taxes, which are just based on how you design the tax policy. You can either place a tax on buyers, or you can place a tax on the sellers. And then once you decide who's going to pay the tax, you can either have a tax as a percentage of the selling price or a fixed amount per unit. So let's look at an example in the market for pizza. Let's say the equilibrium price is $10 and the equilibrium quantity is 500. Now let's say a tax is placed on pizza on buyers. Say buyers pay $1.50 tax per pizza. So let's think about what would happen. So the price that buyers pay is now $1.50 higher than it was before. And so the price would have to fall by $1.50 to make buyers willing to buy the same quantity as before. And so what that means is that demand is going to fall by the amount of the tax. Call this D prime. So every point drops down like this by $1.50. And this distance here is the amount of our tax. And let's be clear here, D is the demand without tax and D prime is with tax. So we now have a new intersection of supply and demand, which is this value. And let's say that corresponds to a quantity demanded of 450. And this new price is about 950. And this 950 price, this is the price that the seller receives. However, the buyer does not pay this price because remember we have the tax. And so the point that represents what the buyer pays, you go from this new equilibrium point up to the old demand curve and then over to the y-axis. And if this is if the price the seller is receiving is $9.50 and the tax is $11.50, then the value the buyer pays is going to be $11. Right? So $11 is what the buyer pays for the pizza now. The seller receives $9.50 and the $1.50 difference gets collected as a tax. In our graph here, this area, that's the tax amount. And then this whole rectangle is the tax revenue. So again, in this case, the buyers end up paying $1 more and the sellers receive 50 cents less. And we call this the incidence of the tax. Put another way, the incidence of the tax is just how the tax is distributed among buyers and sellers. So let's look at the same example, but this time let's say the sellers pay the tax. Well, using the same logic that caused us to shift the demand curve, we shift the supply curve in the same way. So now the supply curve shifts up by the amount of the tax. So this distance here is $1.50, which means this value here represents $11.50. And just like before, we find the point where the demand curve intersects the shifted supply curve, which is here, and then take this over to the y-axis. So this amount here is what the buyer is going to pay. And this is actually going to be exactly the same as it was before. And this value will again be 450. And to know how much the seller receives, follow this point down till it hits the old supply curve and then bring it over. And this is actually going to be 950. The tax incidence in this case is exactly the same. the buyer pays $11, the seller receives $9.50. And so this highlights an important point. The tax incidence is the same if the tax is imposed on buyers or sellers. Another way to think about this is that the price the buyer pays minus the price the seller receives will always be the amount of the tax. So I'll explain this one more way, a little bit differently, because this can be confusing. Let's say this is our same market for pizza, and the equilibrium price is still 10, and the equilibrium quantity demanded is 500. Let's say that the price the seller receives is $10, and the price the buyer is going to pay is $11.50. So the buyer is absorbing the full burden of the tax. So that means they would demand this much, and let's say this is $3.50. So the question is this an equilibrium? And the answer is no, because the sellers want to provide 500 at a price of $10. But if the buyer's paying $11.50, they're only demanding $3.50. And so these values are not equal. And so an equilibrium is one where the quantity supplied and the quantity demanded are the same. So let's look at the same setup again, but now let's say the full burden of the tax is placed on the sellers, which means the buyer still pays $10, but the seller receives $8.50. And the question is this an equilibrium? And the answer is no, because again, the sellers, if they're only receiving $8.50, they're only going to provide some value less than the equilibrium of 500. Let's say it's 200, and the buyers are going to demand 500. And so the tax burden will never be placed entirely on the buyers or the sellers. It will be somewhere in the middle, such that they each share a little bit of that burden. So that will do it for taxes. That's the basics. Again, this is a little bit confusing, so if you have questions, make sure you ask them. I'm happy to explain this again.